Okay, we are going to look at the second company now. So same 41-year-old individual. The funding was $250 for 2 years, $250 for year one, $50 thereafter, and then the other two examples of $175 the first 2 years, followed by $50 and then $100 every year for 5 years. Let's take a look. Company number 2. So the commission rate was a little bit higher up front with this example, or with this company, I should say. They pay just about a 93% commission if you're at the top level, meaning if you bring them a ton of business and you're at the top level, they'll pay about a 93% commission rate on base premium in the first year only. So same design. Everything's the same here. $250,000 for 2 years. Base premium commission, year one, $23,250. PUA commission, so we've got a $25,000 base premium. Company paid approximately 93% in year one, and then the rest, the other $225,000, went into PUAs, of which they pay a 2% commission rate. This particular company does, that is. That's where the $4,500 comes from. And then you've got the total annual commission. So the agent would generate here $27,750 total commission, and then you've got the total amount including renewals as well. So $33,500 compared to $250 in year one, followed by $50,000 per year through year 6. Now, what's highlighted in yellow is our break-even point. This example between 5 and 6. This guy over here on the right, between 6 and 7. So I see up front which one breaks even sooner, $250 over 2 years. Now, let's look at the compensation. Year one's identical because your ratios, base premium, PUA component, are all the same. Same compensation, but now I continue to make payments, generating the renewal commission on the base premium each time a payment is made by the policyholder. Same thing with PUAs, $36,500. So very close in terms of commissions on these two examples here, right? About a $3,000 difference. What's the difference for the consumer? Because if I'm the consumer, really, and this is me personally, how I'm going to view it is, hey, I don't care what the agent makes as long as the policy is set up for my best interest. If that's the case, where everything's optimized, short-term, long-term, cash value, death benefit, I'm happy. I just don't want to find out after the fact that it could have been set up better and it wasn't, or I wasn't shown an option and explained the different options as far as how to optimize it, make it flexible, all that good stuff. I don't want to get into the weeds here though. So let's take a look here. Year 20, what do we got? Here I made $36,500, commission's $875. Over here, year 20, I've got $910,000. So you've got about $40,000 more, right? Yeah, about $40,000 more with $3,000 less in commission. It's interesting how that works. Exact same insurance company, exact same product, all that good stuff. I say 40, I meant 35. Okay. Let's look at company 2 here. Or I'm sorry, same thing, company 2, but option 2. And option 2 is as follows. $175 for 2 years, followed by $50,000 thereafter. Always, right, we always talk about policy design. My money can be allocated toward premium or the PUA component. Here, this company, again, will allow me to go a maximum of 10x my base premium. $17,500, total payment $175. Break-even point with a policy designed for pure long-term cash value. We beefed up the early values, year 5. Same thing over here. $100K for 5 years, $10,000 base premium, breaking even year 5. Very close in the race at this point in time. If we look at year 20, the example on the left, $951, example on the right, $976. So about $25,000 more in value for the consumer. Same company, product, all run directly from the insurance company software. Total compensation, $20,300. Over here, $28,000. So about an $8,000 reduction in compensation immediately in the first 5 years. Let's look at year one actually. That's where the big difference is. $11,000 compared to $19,000. That's the difference. And the value is not that different up front. As time passes, you do see a difference. You actually see a bit more of a difference when you look at the guarantees. So if we look at a more conservative scenario, conservative dividend, the lower premium example will actually spike up a bit as terms as value for the consumer. So like we did with company one here, let's look at long-term, year 50. Which one of the four options gives me the most? We already know which one. It is the one that paid the least. So we've got 3.74 million. Okay. Let's look at options 1 and 2. 250 over 5 years, and then 250 followed by 50 for 6 years. Come on. There we go. 3.74. This one, 3.35. 3.492, call it 3.5. Again, same insurance company, same product, same individual, everything's identical here. We actually have the full details on this case study, both the first video and this one with different companies on our membership program. That goes into details as far as the different insurance companies that were used, how the products were designed, maximizing everything. So if you're interested really in the nitty-gritty details, everything's there, or you can reach out to us. And we're always happy to share details. If you're working with us, if you already have a policy or purchase one, we'll certainly provide the information as well. In any event, I hope that this was helpful just to kind of provide transparency here. I know that this question has come up forever. Consumers are naturally interested. Hey, what is the agent making here? Is there a way my policy can be set up differently? Is there different motives there? Whatever it might be, it's just more information. So again, hope this helps. We'll talk to you soon, and thanks so much for watching. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.